allegiance to the client.
Yeah, that's what you want.
And it's really what you need is if you have that loyalty to the customer, you're the most important person in the room.
Yeah, absolutely.
So we go to the blue option, the green one, the red one, whatever fits or suits. Absolutely. That's where we go.
Hello, everyone, and welcome back to Bamboo, Vancouver's property management and investment podcast. This week, I have Jeff. He's a mortgage broker down in our office. So let's get into it. Jeff Fraser, what's the name of your company? Where you're at? What are you doing?
Absolutely. Jeff Fraser. I'm with Vancouver Mortgage Solutions, and we're a boutique mortgage brokerage firm based in the Cole Harbour area, and we're located here inside Coldwell Banker. Happy to be here.
Nice.
Yeah.
So you didn't come out of the womb as a mortgage broker. What did you do before this? How'd you get here?
I was actually a career banker. So I worked for the Royal Bank of Canada for 18 years.
Okay.
Held various roles in branch, so sales, last branch management.
Yeah.
And then the last half of my banking career was mortgage sales for the Royal Bank.
Oh, okay. And then you just went out and you're like, screw this.
It was it was an easy transition because, unfortunately for me, Big Brother was you had the blue choice and that was it.
Yeah.
Clients need more sophistication, more options, more choice.
Yeah,
so the transition or path to being an independent, client-focused mortgage broker was an easy one.
Yeah, that's actually one of the things I always advise our buyers on when they say, "Oh, I'm going to have a mortgage broker or whatnot," or should I go to the bank or mortgage broker? I always say go to the broker simply for the fact that if Royal knows that Scotia's got a better product, they're not going to tell you because that would be giving business away to your competition, right?
Yes, exactly. Oh, exactly.
And I just like the fact that you guys don't have any like allegiance per se to anybody. It's like, oh, this is the 3. This is probably your better one. Well, there you go.
I have allegiance to the client.
Yeah, that's what you want.
And it's really what you need is if you have that loyalty to the customer, you're the most important person in the room.
Yeah, absolutely.
So we go to the blue option, the green one, the red one, whatever fits or suits. Absolutely. That's where we go.
For sure.
Yeah.
For sure. So obviously the mortgage rates just came out, all that. They dropped a whole 0.25 again. So we're slowly getting back to...
We're getting there.
We're getting back to good.
Yeah.
For the current mortgage rates for investment properties in British Columbia, how do they compare to primary? Like, are there different rates between being used by the owner or being rented out by the owner?
Yeah, I mean, owner-occupied versus a rental property, there is a slight difference. Okay. Some lenders charge a little bit more, some a little bit less. Hmm. So I always find that if you tell clients you're within, say, a quarter point more on a rental than you are on an owner-occupied, sometimes clients get a little bit confused. They're like, well, why is there a difference?
Yeah.
I'm like, well, why are you trying to beat the rate out?
Yeah.
When it's owner-occupied, yes, beat the rate down as low as possible because there's no tax incentive. You can't write it off.
Fair play, yeah.
Right? So with rental properties, interest rates should dictate cash flow.
Yeah.
So what is my monthly payment compared to rent and expenses?
Yeah, that makes sense.
But all of the interest cost on that mortgage is tax deductible, along with the other property expenses.
Yeah, exactly. Like property managers.
Like property managers, exactly. That's why you should have one always. Yeah. But for me, if you push the interest rate down too far, you're limiting your ability to write that interest off.
Yeah, that makes sense.
So sometimes when there is that price difference, not that big of a deal.
Yeah, for sure. So between the different mortgage products, are there specific key features that you'd look for in a mortgage for an investment property over one that you look for owner use or owner occupancy?
One of the big things is you have to have a minimum of 20% down payment.
Okay.
Whereas with an owner-occupied, you can get an insured mortgage, like through Canada Mortgage and Housing Corporation, where you can go with 5% down or 10% down. Yeah. With an investment property, you have to go in with 20. Mm-hmm. The product itself, though, is very similar to an owner-occupied or a rental.
Yeah.
On a rental, though, there are some other niches for some of your perhaps more sophisticated investors. Things like putting it into the name of a holding company.
Yeah.
So You can do that under a rental. You might not do that under owner-occupied.
Okay.
One of the other options you have with an investment property is a 30-year amortization.
Yes.
So you can stretch it out as far as possible.
Which makes more sense for cash flow, of course, right?
Makes more sense for cash flow. Also, there's more interest there to write off because you're paying more interest on a longer amortization as opposed to a shorter one.
Okay, that absolutely makes sense. So thinking about more of as a business write-off than as opposed to try to just beat down the mortgage as quickly as possible.
No, let the tenant pay it down.
Yeah,
exactly.
That absolutely makes sense. So we just touched on the down payment and that you need 20% to buy the investment property. For those that are already living in those, that they put down less, they can just move, correct? Or do they need to top up to make sure that it's that rate? Like if you were living in your own place, it's another one?
It's a bit of a gray space because when you went into the original one with 5 or 10% down, the intention was to occupy it as a principal residence.
Yes.
But the industry is aware that people change, lifestyles change. So it is a bit of a gray space, but commonplace, honestly, is that if you can convert it to a rental, even though your equity position may not be 20%. It's not the ideal situation, but people do it all the time.
Yeah, I've seen some people that are needing to, move out of town for work for a couple of years.
Exactly.
They've only been in their place for a year or so, and they're like, "Oh, can I rent this?" And say, "Yeah, I think you can."
They totally can.
Yeah.
There may be some cash flow concerns because if it's got a high mortgage, a high payment, converting it to a rental, they'll have to assess whether it works for them or not. Yeah, but definitely they can for sure. Yeah,
that's a good tip for those who are thinking about whether to make a move or how to make a move.
Yeah, exactly.
So now, can you explain the difference between a fixed rate and a variable rate mortgage on an investment property, and which would you typically recommend? Yeah, that's a hot one because the rates went up substantially.
It's a very loaded question.
Yeah, but in our current state, even with our one that just came down on the rate, what would you? If somebody just came in and like, should I get a variable or a fixed term for my investment property? What would you suggest, or what are some aspects that they should look at?
For me, with fixed rates, and this is just my personal view. I never go fixed or recommend too long because situations change, your financial situation can change. So do you really want to have a long-term fixed commitment on a revenue property?
I gotcha.
I might hold it, I might not.
Yeah.
I might move. I might get engaged or married or have a kid and life takes you in a different direction.
Absolutely.
So for me, I've always recommended clients don't fix more than 2 years.
Okay.
3 max.
Yeah.
2 to 3, that's it. On the variable side of things, most variable terms are 5 years, but what's guaranteed in the variable term is the discount off of the prime rate. Okay, so prime minus whatever gets you to that effective rate dictates your payment. The main reason for fixed or variable is if people have to get out, do I have to pay a penalty? What does that penalty look like?
Yes.
In a fixed term, usually it's 3 months of interest cost. Sometimes, though, depending on the lender, it can trigger a higher penalty called interest rate differential or IRD. Yeah. The longer you commit to a fixed term, the greater the potential is that it could flip to that higher penalty.
Oh, I see. So it could get like a 5-year fixed, and when you get out after the first year, you're gonna get walloped, probably, right?
You could totally get walloped. Like what should be a $5,000 or $6,000 penalty, I've seen it come out at 15.
Wow.
Whereas
that'll change the numbers.
That can eat into your profit big time.
Yeah.
So the other piece you want to look at though is variable rates. They never have an IRD or an interest rate differential. It's 3 months interest at the effective rate. That's it. You're out.
Okay,
so for me, I would recommend a variable rate, or if you feel more comfortable with fixed, go shorter term. I would say 3 years or less.
Okay, that's a good tip for sure for all our viewers. The other thing I was going to ask you about as well is porting a mortgage. This is a term that's commonly used. One, what does it mean for anyone who doesn't know? As well as, can you port a mortgage on an investment property? So say you had one, is going, but all of a sudden you can get a smoking deal selling this and buying the new one or whatever. Can you port that mortgage over? That's maybe give us a quick overview on porting.
Sure, portability. So portability, You nailed it. Pick it up and move it from A to B. That's all portability is. Majority of lenders within 3 months.
Okay.
So what you want to do is if you sell the current one, and you have to buy another one within 3 months.
Okay.
So if you sell one and buy right away, usually there won't be a penalty. You just pick the mortgage up as it is, move it from property A to property B.
Okay.
It's when you sell the first one and there's a gap
before
you close on the next one. So you sell the first one, the mortgage is paid, the penalty is assessed.
Okay.
Within 90 days, you have to buy another one.
Yep.
Put the old mortgage back on.
Yep.
The way it looked, dollar amount, rate, amortization, mirror image.
Yep.
Within the 90-day period, then the lender will reimburse the penalty back to you.
Okay.
So if you port an increase, there's probably going to be what's called a blended rate.
Okay.
If there's a port and a decrease, in other words, I go from a $500,000 mortgage to a $300,000 mortgage. I bought a cheaper place, don't need as much money.
Of course.
The penalty would stand on the portion of the mortgage you don't take forward.
Okay, so just in this example, the $200,000 difference
Would have a penalty outstanding.
And that would probably be the 3 months.
For the most part, yeah.
Okay, that makes sense. Mm-hmm. So what are some key factors that lenders consider when approving a mortgage for an investment property in BC? And how important is the credit score? And obviously income stability is important, I'm sure, but what are some of the key factors that they're looking for when determining whether to give an investment mortgage?
Main thing, other than the obvious ones, credit needs to be strong, income needs to be strong, down payment. The biggest thing they look at, liquidity.
Okay.
Now, what do I mean by that?
Yeah.
Liquidity, cash.
Yeah.
After your down payment, how much money have you got set aside?
Nice. Absolutely.
Right? So if something happened, what if the tenant doesn't pay? How are you going to make those payments?
Yeah.
How much other liquid cash or liquid resources do you have? That plays a huge factor in with investment properties.
Now, do they also consider like your TFSA or anything of that nature, or is it just straight cash?
So types of liquidity.
Yeah.
It can be retirement savings.
Okay.
But retirement savings, you're going to have to pay income tax if you had to cash them out to use them.
Yeah.
TFSA, absolutely.
Yeah.
TFSA is cash.
Yeah.
When I say cash, I don't mean money under the mattress. It's anything that can be easily converted to cash.
Okay.
So cash in your TFSA, sell your stocks. If you have money under the mattress, pull it out. Bitcoin. It's a tougher one these days because it's hard to validate what Bitcoin is worth. You can tell me it's worth 50 grand. How do I know?
Yeah. That's it exists.
It's the challenge with it. So if you do have it and you need it, just get it out of wherever it is and put it into a legitimate source where it can be benchmarked or validated from a value perspective.
So actually, it's funny that you bring up Bitcoin and all these...
I wasn't planning to.
We're there. We'll go down the tangent.
Sure, yeah.
How do you prove Bitcoin? Like, could you not just print out a thing and saying, you could doctor that and something?
Well, see, that's the thing. And it's funny that we're mentioning this because I did a transaction with a guy 2 or 3 years ago.
Yeah.
He had a significant amount of it. And he told me, and I knew I couldn't prove it. Because it's like, well, sure, you can tell me you have $1 million. Like, how do I know?
Yeah.
So what I told him to do, he was buying something, but he had a long completion.
Okay.
So I told him, get it out and put it in the bank.
Put it into real world money?
Real money tomorrow. And he did. And I said, you got to let it sit there for 3 months.
Yeah, of course.
So that when we show the bank 3 months of history, it's been in a source that we can benchmark or validate the value against versus pieces of paper, as you say, that could have been doctored by a 12-year-old.
Yeah, you can print that, right?
Exactly.
And speaking of credit and all that, what are some great ways for someone to fix their credit? Say you're starting to do the pre-approval, they've got a couple of bombs. We're all in our 20s doing dumb things at clubs. Mm-hmm. So what are some of the best bang for your buck to fix your credit ASAP as opposed to like a long drawn out process?
The biggest ones I've seen are, like you say, it's the 20-year-old stupid stuff, which was, and now I am going to use curse words, you get in a pissing match with TELUS or Rogers or BC Hydro. The ones that I see that most problematic are the small ones.
Okay.
Just pay the damn thing.
Fair enough.
Pay it now. Pay it yesterday.
Yeah.
I know you don't want to. At a principle, pay it.
Yeah.
And pay it now. Then moving forward, start paying everything on time.
Okay.
So that's really the biggest thing is pay on time. People think I have to pay everything.
Mm-hmm.
No. All your accounts have minimums. Minimum credit card payments, minimum this. Pay at least that on or before the due date.
Okay. That makes sense.
Don't max out every credit card you have.
That would probably be a good indicator.
That's
probably
a
how
tough
you got
one.
there in the first place.
Yeah, and some people too, what they do as well is they don't realize your credit score is driven by the account you've had the longest.
Oh, okay.
So they go in and they say, well, I've had this Visa card for 12 years.
Yeah.
I don't use it anymore, and they get rid of it.
Okay.
It actually can make your score go down.
Really?
Because
the
the trades you have are newer.
Yeah.
You just knocked off the most established one you had.
Huh.
Right? So sometimes if you're going to cancel accounts on your credit report,
yeah,
cancel the newer ones, hang on to the oldest ones you've ever had.
Okay, that's a really good tip. Like,
yeah.
Would never have occurred to me because I
a lot of people think
it's a credit card, right?
Yeah. or I broke up with somebody, so I got to get rid of, and we've been together for 12 years, so let's get rid of that card.
Yeah.
Well, maybe that's not the right approach. So,
if there's two on that credit card, can they split them?
No.
No. So one person's going to want to get
what always happens with credit cards is it's your account, for example, that you've given me joint access to.
Okay.
I'm the number 2, you're the number 1. You're the primary card holder.
Yep.
So it reports to you.
Okay.
And you would just keep it and cut off the co-applicant, but you can't take the account and split it into.
Okay, that makes sense. So the co-applicant is SOL.
SOL. Yeah, out you go.
No worries. Now, are there any provincial or municipal regulations that investors should be aware of when they're securing a mortgage or an investment property?
I think the main things to think about are tax implications for me.
Okay.
Because as we talked about earlier, you have to claim your rent. And then you claim the rent on your tax return, but you could write off all of the associated expenses from property management to property tax to repairs and maintenance, interest cost. I always say that on paper, it should look like a money loser.
Okay.
You do not want that property to have positive net income.
Yeah, it's best always like
break even or loser.
Okay.
Because anything positive gets added to your employment income.
Yeah.
It could actually push you into a higher tax bracket. So I always advise clients right off the bat, like, no, on paper you want this thing to be a money loser. Which is why, circling back to interest rates, don't beat the crap out of the interest rate.
Mm-hmm.
Because that's less interest costs that you can deduct, which could put you in a positive cash flow position.
Yeah, and then you can...
And taxes,
I got you.
Taxes, I think, number 1 with revenue property, get advice from a tax professional.
Yeah, that's always a good idea.
Well, the other thing that happens as well, people try to rent properties out. I don't want to claim the rent, but then I'm going to move back in and I'm going to sell it and try to claim it as my principal residence.
Yeah.
Just don't do it.
Well, especially now with all these new rules. I mean...
Well, all these new rules, and the government's auditing everything.
Yeah.
Provincially, they're auditing. Federally, around GST. Just, no. Don't try to skirt the rules. It's just not worth it.
Absolutely not. So with the mortgage terms and amortization, we talked about the differences. You can get a 30-year, not 31-year. You got to be a little bit more clear here.
Do you know something I don't?
Right. You can get a 30-year amortization with 20% down. I know that there's a product out there for mortgages, at least it used to be, I believe, that was the Mortgage Plus Improvements. Now, does that apply?
Purchase Plus Improvements.
Purchase Plus Improvements. Does that apply to an investment property? Like, could I buy one that has been beat down and sort of add my improvements into that, or is that only for owner-occupied? What are the rules around that?
Yeah, it's primarily designed for owner-occupied.
Okay.
Because the majority of homeowners with those types of products are going in with minimal down payment.
Yeah.
Whereas investors are going in with 20% down or more.
Yeah.
So the short answer is Purchase Plus is designed for owner-occupied.
Okay.
Are there possibilities to find some creative strategies? Always. So if anyone listening has a structure that they want to talk about,
okay,
let's take those one off. And there may be a creative solution that at first glance may not present itself.
Yeah.
But when we dig deeper and dive into it a bit further, we may be able to do some form of restructure to accomplish exactly what you're talking about.
So
for sure.
It's talking along the lines of maybe taking out some equity or
possibly,
that sort of thing.
Definitely.
Cool.
Refinancing something, yeah.
Okay.
Lots of options.
Yeah, so there's options to discuss.
Oh, absolutely.
We do see a lot of those. Like, I'll have clients that are looking at them and like, oh, that's a great one, and we can just fix it up.
Like, but it just needs a bit of this or a bit like new kitchen floor, what paint, whatever it is, right? Yeah.
So they just need that little extra
to
get in there, as well as sometimes you have to talk them off the fence, because this is an HGTV. It's like, oh, we'll just throw a kitchen in there. It's like,
no. I used to use this analogy because living downtown, I worked in the West End for quite a bit of my career. A lot of the West End rentals can have, you've seen it, right?
Yeah.
I called it like pink sink, blue toilet syndrome because they all have pastel bathrooms.
Yeah.
It's a rental. Do you care that it has a pink sink or a blue toilet? Who cares?
Yeah.
It rents for $2,500 a month. Does that cash flow against the mortgage? Yes, it does. No, it doesn't.
Yeah.
The HGTV syndrome shouldn't kick in because it's not going to drive the rent up.
Yeah.
In this town, anyway.
The rents are astronomical right now.
I defer to you on that, but that's just my view on it. So
yeah, absolutely. So when somebody's looking to get a mortgage, what are some of the common pitfalls that investors make, whether it be applications or decisions, or really, like in your experience, what are some common things that people maybe oversight or miss, and how can they be avoided?
Pitfalls. So pitfalls are always tough. Like I mentioned before, people who want their cake and eat it too.
Yeah.
That's a big one.
Yeah.
Sometimes certain lenders, you have to be careful. Some of them, they'll allow you to buy a rental property when you don't own a principal residence.
Okay.
Some of them get a bit ornery and they're like, well, if you can't afford your own house, why are you buying a rental? So again, it comes down to structure for me. I never want to say no to anyone.
Yeah.
One of the other things with buying rentals that people have to be aware of is don't put all your eggs in one basket.
Yes.
You can be loyal to this lender, loyal to that bank, loyal to over here. A lot of the lenders may not advertise it, but for the more sophisticated client, they actually have a thing called a door policy.
Okay.
I don't know if you know what that means.
No, tell me this. Have you ever heard of this?
Well, door policy could mean we like you, but we don't want to lend to more than 5 units, but you've got 8.
Okay.
Or you have, like I've seen ones where clients have 25 and 30. I know, it's insane.
Hell of a portfolio.
It is a hell of a portfolio, but with 25 mortgages, it becomes quite a juggling act.
Absolutely.
So what I say to clients is don't put all your eggs in one basket. The bank will like you up to a point.
Yeah. And
when you hit that threshold, they'll just say thank you and we're done.
It's the door.
Go somewhere.
That's the other door policy.
Yeah, the other door policy is the front door. Yeah. So I think a big thing is just always speak to a mortgage professional.
Yeah.
Find out what have I got? Where do I stand? Where can I go?
Okay.
Yeah.
Yeah, that's definitely some good tidbits that you've been giving us, and it's actually a great leadway because you're talking about people who own 25 properties and whatnot. With owning multiple properties, like how does that impact one's ability to get additional mortgages? Because obviously now I've got a bunch of debt. I mean, they're making money.
Yeah.
As the price goes up, and hopefully cash flowing are pretty damn close too. But how does that impact? Like, how do you get 25?
Well, it comes down to the sophistication of the borrower, because the people who have 25 probably have a lot of disposable income.
Yeah,
they've probably got a lot of cash they won't want to put into the market in some way.
Okay.
So that's one piece. Some people, the lenders look at them sometimes as, is this investment strategy or are you running a side hustle, like a side business? So sometimes when you get to that 20 or 25, They may say, we'll lend to you under our commercial portfolio and not residential.
Okay.
This really isn't a residential file.
Yeah.
This is a business.
Yeah, absolutely.
Like, you may have an occupation, but you're running this as a side business.
Yeah.
So a lot of it can be, it can be challenging when you get usually up above 10.
Okay.
I find when clients have 3 or 4 or more, they start looking at holdcos. You'll hear that a lot.
Yeah.
I want a residential mortgage in a company name.
Okay.
That's what a holding company is.
Yeah.
So it doesn't produce any other revenue but revenue from real estate rental.
Yeah.
So there's no operating income. You don't produce anything. A holding company holds it in a corp.
Yeah.
But the owner of the corporation is personally liable and personally has to guarantee the mortgage.
Okay.
So the bank will say, you can put it in 123-456 BC Ltd.
Yeah.
Haze is the owner of that corporation.
Yeah.
So the title goes in the company name, the mortgage goes in the company name, but the mortgage is on your personal credit file.
Okay. Now, how does that work as far as purchasing? Like, if you just get a holding company, it's zero, so they have no credit really. So that just goes on to your personal credit.
That's why the owner of the holdco has to personally guarantee.
Oh, okay.
So, are you using income from the holdco? Not really.
Yeah.
It's based on your employment income as the owner.
Yeah.
The tax advantage to it is all the revenue goes into the holdco.
Yeah.
Not into your personal.
Yeah, I gotcha.
When you sell the property, the profit goes into the corporation and is taxed at the corporate rate, not your personal rate.
Yeah.
It gets taxed in your personal hands if you pull it out of the corporation and put it into your own personal bank account.
Yeah.
So what a lot of people will do is put them under these corporate structures. Now it involves extra legal fees, separate accounting filings, so there's extra costs involved. It's not for the faint of heart.
Yeah.
But if you make a $200,000-$300,000 profit, you keep it in the corporation, you pay your corporate tax, you can then turn around and take that as the down payment to buy another one.
Okay.
There's no personal income tax hit because you never took it out.
Yeah.
So a lot of people will keep it in a corp and just pull it out personally over time as a way to minimize tax, not avoid it, just minimize it.
That's an absolutely great method to really grow that empire, if you will.
Totally. And a lot of clients, too, what they say is, when does it make sense for me?
Yeah. Like at what point in time should you
at one unit? Probably not.
Yeah.
I typically see clients do it as little as 2, 3 to 4 normally.
Yeah.
Is when they find it's cost effective.
And is that including their primary? Like, do you want to put your primary into the holdco as well?
The primary stays out.
Okay.
Because your primary residence is tax exempt for now, unless the government does something weird and wacky.
Which these days you don't know.
Who knows these days? You can't tell. One day they're up, one day they're down, one day they're sideways. No, primary residences are tax exempt. Okay. So I bought it for $500,000. I sell it for $1 million. Yeah. After you pay the commissions, you pay the mortgage. The profit is all yours. Yeah. That hasn't changed. Okay. So there's really no point to have it in a corporation. So keep your primary in your personal name.
Oh, absolutely.
Unless there's a legal or an accounting reason to do otherwise.
Okay.
But do that on consultation of a tax professional.
So basically, in a nutshell, you'd say, very basically, if you're getting up towards 3 investment properties, start considering a holdco property.
I would. Talk to your accountant, your tax professional, and they'll tell you, it's worth it because of this and this, or it isn't. Leave it as is.
Okay. Yeah, that absolutely makes sense.
Because I've got clients that have 7, 8, 9 in their personal name. They don't bother with a holdco.
Really?
Yeah. I think a lot of it depends on, do you need the money out?
Yeah.
So for people who don't need the money in their personal names, why pay the capital gains tax?
Yeah.
Keep it in the corp, roll it over, leave it. It can just sit there, do nothing.
Sure, right?
Yeah. So it's more of, if you don't need it, leave it in.
Okay.
And if you're leaving it in, there's probably advantages to having a corporation versus in your personal name.
Yeah, absolutely. Now, we were talking about cash flow through BC and all that. It's very difficult to cash flow, just as you touched on. Rents are astronomical.
Yeah.
Purchasing is pretty high right now, although it's kind of leveled out for the time being, but we'll see what this new rate change does if it actually gets people firing again. Because I think that a lot of people were waiting for that.
Oh, 100%.
And typically it slows down in August anyways, because everyone's thinking, beaches in Disneyland not doing tax stuff and all this other stuff.
Buying houses.
Yeah, exactly, right? So with that saying, there's other places in Canada that are easier cash flow. New Brunswick or Alberta or wherever, right?
Yep.
Can you deal with mortgages in different provinces, or is it just in BC that you can work? Do you have to get a different broker? How does that work?
That's an interesting question. So as an independent mortgage broker, I have a license in British Columbia. Mm-hmm. So I can broker deals in BC.
Okay.
Our company, Vancouver Mortgage Solutions, we're part of the Mortgage Architects network.
Okay.
Which is a national network of mortgage brokers.
Yes.
So we actually have a deal desk. And they've got people who are licensed in multiple provinces.
Oh, okay. So you can theoretically.
Yeah, we can work the deal here. We just have to submit it to them. They send it to the lender in that particular province because they have the license to do it.
Yeah.
But they get it approved. We deal with the customer here. So yes is the short answer to your question.
Now, and speaking with that, you said that there's in a different province, obviously, that. Are there different rates in different provinces? Like, is the mortgage rate in New Brunswick different from the one in BC?
Hopefully not. It shouldn't be.
Yeah.
Because if you're dealing with a national lender, the rate should be consistent across the country.
Okay.
Unless there's specific reasons for regional pricing differences.
Okay.
So it shouldn't be. It could be. If you're dealing with a regional lender, well, that's going to be a whole different ballgame.
Yeah.
Like if it's a credit union in Ontario versus Bank of Nova Scotia, there will be a difference.
Okay.
Right? But if it's the same deal at Scotia or TD, the rate should be consistent across the country.
Now, would you recommend dealing with a regional? Would they have a better angle at getting a better rate, or would you recommend sticking with national because they're just bigger?
Depends on the client.
Okay.
Depends on the property type. If you're buying a cottage in Muskoka somewhere in Ontario, maybe a regional credit union fits that particular transaction.
Yeah.
I grew up in Prince Edward Island, for example, and I have a summer home back there.
Yeah.
But it was a unique property.
Yeah.
It's older. It's outside of a major city center.
Yeah, for sure.
The bank wasn't the solution for me.
Yeah,
because the local credit union knew the market better. Mm-hmm. So that was an example of where I got what I needed.
Yeah.
But the big bank wouldn't do it because the property was too far away.
That makes sense.
So sometimes we run into that as well.
Yeah. Okay. Well, that's some good advice for anyone thinking about purchasing outside of BC, just because I know that I've been asked by a bunch of people, like, holy cow, I can buy a duplex in Nova Scotia for the same price I can buy a junior one bedroom.
I know.
So why am I doing this? I'm going to go buy that.
Well, and having spent a lot of time back there the last few years, rents are higher back there than they've ever been. So all of a sudden, a cheaper property requires less down payment to make it cash flow.
Yeah.
So your typical property in British Columbia, you probably need, I'm going to safely say 40% now at least, if not even more with current interest rates.
Yeah.
For it to cash flow.
Yeah, absolutely.
But you go back to some of these other markets, you put in 20%, the numbers work.
Yeah, absolutely. Well, that's
so all of a sudden, bang for your buck, going out of town's not a bad idea.
Yeah, for sure. And it's just a matter, of course, hiring a manager in that, because you're not going to fly across the country to put a 10-day notice up.
No.
Right?
Not when there's a pending airline strike. So
you
never know, right? So
you may not get back.
You get stuck.
Yeah, absolutely. Wicked. Well, I think we covered most of the topics that we were planning on covering there.
Fantastic.
If someone wants to get a hold of you to learn more or get a mortgage, for that matter, where do they find you? What's the best way to get a hold of you, Jeff?
Best way to get a hold of me is probably my cell phone, 604-340-1809. Alternatively, via email, and my email is a bit tricky, but it's my first name, so it's Jeff, Jeff, and then and it's Jeff Fraser, my whole name, JEFFFRASER, I know, .ca. So either cell phone or email. I am in the office most days, and we're located here at Colville Banker Prestige Realty in Cole Harbour.
Perfect. Yeah, and we'll have all your information in the description below there, so it'll be really easy for you to get a hold of it.
That's fantastic.
And just cut and paste it. So, thank you very much for coming on the show.
Hey, my pleasure. Thank you for having me.
And thank you for tuning in. This has been Bamboo, Vancouver's Property Management and Investment Podcast.